Hello, everyone. Thank you for joining today's Year-End Planning Steps and Considerations for Success in 2021 webinar. Today's program will be presented by Daniel Mayo, Jeremiah Ramos, Kimberly Phelan, Hal Ter, and Jim Bartek. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. Also, at the bottom of the toolbar, you will see a question box. All questions pertaining to the webinar content will be answered at the end. We will do our best to address them. There will be 5 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to our team.
Great, thank you very much. And thank you for joining everyone today on this webinar. This is one of my favorite webinars because we give a lot of practical tips on this one. So when you finish this webinar, you should have a couple good ideas on how you can lower your taxes in 2021, and some ideas if you're an advisor, some ideas you can bring to your clients on ways they can save money this year. So hopefully you have to keep that in mind. You can walk away with a few good ideas and year-end strategies to implement in the next month and a half. So with that, I think we're going to start today talking about the election and the reconciliation bill that's pending, and sort of where we are and where we're going. You know, the Build Back Better bill is the big thing today, right? And so this is the big uncertainty at year end, right? What's going to happen? Are they going to pass this legislation? We know this past Monday they passed the Infrastructure and Jobs Act. So that got rid of the employee retention credit for the fourth quarter, as we'll see, and did some other things with reporting on crypto, et cetera. But the real revenue raisers are going to be in the reconciliation bill, or the Build Back Better proposal. So I thought it would be good to see just a brief history of where we've been and where we're going with Build Back Better. So we know on the campaign trail, Biden proposed a lot of ideas. They were put together in his Green Book, which came out around April, I think the end of April this year. Then in September, the House Ways and Means Committee came out with a Build Back Better proposal. And this was a very specific set of proposals, a raft of tax increases. But then they received a lot of pushback from Senators Manchin from West Virginia and Sinema from Arizona. And recall they have in the Senate, in the Senate, the Democrats have a 50-50 split with the Republicans. So they really need every senator on board, and then Vice President Harris will cast the deciding vote. So they received some pushback from the moderate Democrats, or so-called moderate Democrats, you know, Manchin and Sinema, that were objecting to the large price tag put on legislation by the progressives. The progressives said $3 trillion was their compromise from $6.5 trillion, and Senator Manchin and Sinema said we're thinking $1.5 trillion. So there's it seems to be settling now around the $1.5 to $1.75 trillion range. But since then there have been a lot of changes. Various proposals came out: the billionaires tax, that mark-to-market proposal that went nowhere fast, the corporate minimum profits tax, which stayed in and is likely to become part of Build Back Better, a bunch of other proposals. But then the White House issued its framework document at the end of October, where they really got rid of most of the tax increases and sort of crystallized them into a few. Then we had the House, the manager's amendment to Build Back Better on November 3rd, which was similar to the White House framework. So the House is expected to continue negotiating this week. And they're also expected to get opposition in the Senate. Whatever they pass is likely, when it goes to the Senate, they're likely to hit some opposition and have changes. Then they're going to have to go back and forth to reconcile the views of the senators and Congress people. Legislation could take weeks. It's not clear when it's going to happen. The latest prediction I heard was probably middle of December is when they would pass it, possibly in the week between Christmas and New Year's. I think it's still likely. You say passage of this bill is still likely, although what it contains is not quite clear. On the next slide, we see that the tax provision has definitely been a moving target. As I mentioned, a lot of them have been coming in and out. Many were eliminated, which was nice to see. And we're really not clear what the final bill is going to contain. Although we'll get into some specific provisions coming up, but it is likely to contain money for the IRS. In particular, you see that $45 billion allocated to enforcement, where they want to catch they view as fixing the tax gap of unreported income by going after high net worth taxpayers. Okay, next slide. So these are some of the individual provisions that are likely to come in. They're in the current proposals. You see that 5% surcharge for taxpayers making more than 10 million, and then an additional 3% for people making over 25 million. So the top ordinary income rate is going to go to 48.8%, very high, right? So how do we get there? It's a 37% rate. Recall there was a proposal to increase it to 39.6, which is before the Tax Cuts and Jobs Act, but that was pulled as well. So rate stays at 37, then you have the 3.8% net investment income tax, the 5% surcharge over 10 million, the 3% surcharge, and that's how you get that high rate of 48.8%. The expansion of the SALT deduction limitation, that's currently 10,000, it's set to expire in 2025. The proposal had it as 72.5. Some other senators were talking about raising it to 80,000 and extending the limitation to 2031, because it's going to be has a very high price tag on it. And I know the day it came out, other senators came out and said they object to it. Maybe they would raise the cap for those making over 400, only those making less than $400,000. So there is some debate about whether and how this SALT deduction limitation, state and local tax deduction limitation, gets expanded. Qualified small business stock is another surprise inclusion in these tax provisions. So a qualified small business stock is a provision that enables taxpayers to exclude up to 100% of the gain of up to 10 million or 10 times their basis if it's a qualified small business. And there's 3 different percentages, 50, 75, and 100, depending on when the stock was acquired. What the proposal will do is that if a taxpayer makes over 400,000, they lose the availability of the 75 and 100% exclusion, so everyone would get 50% over 400,000. But the way they calculate that 400,000, which wasn't immediately obvious when you read the summary, but when you actually go to the text of the legislation, proposed legislation, the way they calculate it is they include the gain from the sale of the stock. So as a practical matter, most clients, most people on this call, if you're selling qualified small business stock, you'll likely get that 50% exclusion, because your ordinary salary income plus your stock is likely to be over 400,000. This is the one retroactive component that remains today in the legislation. It would be retroactive to sales after September 13th, the date it was first introduced. There is a binding contract exception. Letters of intent typically are non-binding. You get that question a lot. So if you have a letter of intent signed, typically that would not fit you in that binding contract exception to get out of this retroactivity piece, unless you had one of those unusual LOIs that were binding, and some of them are binding. It can be written either way. Typically they're non-binding, but in some cases they're binding. So if you had that would be a binding contract in that case. And if the contract existed prior to or on September 13th, then you could, the retroactivity would go away. You'd get the 100% exclusion this year. Other things, adding cryptocurrency to the wash sale and constructive sale rules. Remember, the wash sale rule says if you sell a stock and buy it back within 30 days, then the loss is denied and it gets added to the basis of your replacement stock. Constructive sale says if you have an appreciated position and you put certain hedges on, you're treated as selling the stock even though you do not sell it. But that's like the short sale against the box is the classic example of a constructive sale transaction. So they're expanding that to include cryptocurrency. So if you, this year, the rules will not apply, but they would apply next year if this comes in and Build Back Better. Commodities and currencies were not previously subject to the wash sale rules. This is an odd thing. They should have been for many years. They're going to fix that now and add them in. Net investment income, big expansion here to include active trader business income. So this would greatly expand that 3.8% net investment income tax for taxpayers making over 400,000. And then you have this extension of the excess business loss limit. That's 461L for those tax people on the line. For non-corporate taxpayers, there's currently limits of, I think it was 250 last year for individual, 500 for married. It went up this year to 260 and 510, somewhere around there. I think we have them later in the slides, the actual numbers. But they would permanently extend these loss limitations and eliminate those thresholds. So no excess business loss would be deductible. So very big change here on the for the EBL provision. Next slide. We talk about retirement provisions in the legislation, then we'll get to corporate tax stuff on the next slide. So on the retirement side, again, trying to keep this short, if you have an IRA or Roth IRA in excess of $10 million, essentially what they're going to do is limit your ability to contribute additional funds to the account and increase the required minimum distributions for these large accounts starting in 2029. And these two provisions are a response to the that Peter Thiel was reported in the press to have over $5 billion in a Roth IRA, which is pretty staggering. Apparently, he put some PayPal stock in his Roth when it was virtually valueless. It's since appreciated tremendously. So he has $5 billion of tax-free money in a Roth, sitting in a Roth IRA. Pretty staggering. So he would get hit by this provision, required to make significant RMDs. They're also proposing to eliminate these backdoor Roth conversions with after-tax funds. This is a great strategy we've been advising for years. If you put say you're 19.5 and you're 19,500 in your 401k for the year, say you're 50 or older, you put in your additional 6,500, right, for the catch-up contribution. If your plan allows, you can put after-tax money in your regular 401k or IRA, and then you transfer that over to a Roth, and there's no income limit for that transfer. So it's a way to, that's why they call it the backdoor Roth. It's a way to fund a Roth IRA, even though you are well over the income limits to be able to contribute directly to a Roth. So that backdoor mechanism, they're going to shut that backdoor. So they call this the backdoor. It's funny that they have the side door was the way people got into college, right? With that, his name was Rick Singer, but they call this the backdoor conversions. Okay, so they also would eliminate regular Roth conversions, right? Now you can convert an IRA to a Roth without regard to income limits. They would start putting limits on this 11 years from now in 2032. And the last is a 15% prohibited transactions tax would apply to IRAs that hold in FISC or DISC. Those are two entities that throw off a lot of dividend income. And so there are a couple cases where taxpayers, they prevailed actually. They put these foreign sales corps inside a Roth IRA. So these companies just spit off a lot of income. And so all this income was going tax-free into a Roth IRA. And in a couple of cases, the courts looked at it and said that it works, the transaction works. So they're stopping that here. Other provisions shut it down earlier, but additional prohibited transactions tax. So next slide, we talk about the business provisions. This 15% corporate minimum tax is the big one on corporations with income over $1 billion. So mostly really large corporations are going to get hit by this. The middle market's not really going to get impacted by this provision. Similarly, the excise tax on stock repurchases of publicly traded companies. This is what their concern is, that these companies are, rather than distributing the money as dividends, which should be taxable to shareholders, the company's just using the money to buy back their shares, thereby increasing the value of the company because the earnings per share increases when less shares are outstanding. So this buyback tax is something that, the excise tax is something that's likely to come in as well for the Build Back Better. A couple of small provision here is the plaintiff's attorney's fees. Normally they wait until the case has to be over on a contingency fee case. This would allow, effectively put them on a cash basis rather than having to hold the expenses until the end of the case. And there's numerous international tax reform proposals, which Kimberly will talk about later in the presentation today. What's not in the bill, and so the individual rate increases from 37 to 39.6. People will be very happy to hear this. By the way, I see a lot of questions are coming in. We're going to keep going with the presentation today, but we did budget 20 minutes at the end. So we want plenty of time to get to your questions. So please keep submitting them, and we will definitely get to them at the end and read through the questions and answer as many as we can. They're not increasing the corporate tax rate. It's a flat 21% today. They had proposed reducing it to 18% for certain low income companies, then a 21% and a 26.5% would be the highest rate. So that's not going to make it. They're not going to increase the long-term capital gain and qualified dividend income rate from 20 to 25%. That one was proposed to be retroactive, so thankfully that's out as well. No changes to carried interest provisions or qualified business income deduction. This is another small provision which affects very few taxpayers, but if it does affect you, it's fairly significant. There was a 2-year period when S corps could convert tax-free to partnership status. S corp gets too big and they're breaching the 100 shareholder limit. It's harder to attract talent, so where they want to convert to a partnership, and the only way to do that is through a liquidation of the S corp, which would be taxable. So they had put in a 2-year provision for allow certain S corps that were in existence, I think in 1997. They could then convert tax-free within the next 2-year period. That was removed from the proposal. Again, mark-to-market and unrealized gains. This was that billionaire's tax, and there also was a proposal to eliminate the step-up in basis and reduce the lifetime exemption for state and gift tax from 11.7 million per person today to around 6 million. So those were eliminated as well, thankfully. And Hal will talk about that later when he talks about state and tax year-end tax planning for state and tax issues. Next slide. Okay, so now we're going to get into some real specific things here. What can you do this year, year-end, in the next month and a half to lower your tax bill? And so we'll talk first, we'll say, but the general rule is you want to defer income and accelerate expenses. And that still applies for most people. But if your income is likely to be over 10 million or over 25 million, you might want to rethink the strategy. Maybe it doesn't make sense for you, because by deferring income this year, you put it into next year where you have those higher rates at 48.8% that we talked about would apply to your income. So accelerating income might be a strategy for certain high net worth taxpayers. And we've seen that in our client base. We have some clients who are accelerating significant amounts of money this year in anticipation of tax reform. So how do you defer it? If you want to defer, you're not in that 10 million or $25 million income bracket, how do you defer? You can do it if you sell real estate, you can do a like-kind exchange. If you invest within 30 days, you can invest your capital gain in an opportunity zone, right? This provision came in the 2017 Tax Cuts and Jobs Act. If you have any gain, any capital gain during the year, you can reinvest it within 180 days into a qualified opportunity fund in an opportunity zone. And if you get it in by year end, end of this year, you can still qualify for, you defer the gain. If you hold it 5 years, you'll get a 10% elimination of that gain. And any investment you get on the qualified opportunity fund, if you hold it more than 10 years, is zero. So you have no capital gains on the gain in the qualified opportunity fund. So significant opportunity. Except for those of you who are really attuned to it, there was you can eliminate 15% in total of the gain that you use as a ticket into the opportunity zone. That went away this year because you can't meet that 7-year holding period before 2026. So at this point, you're looking for that 5-year holding period. If you get in by year end in an opportunity zone, then you can eliminate 10% of the gain that you realize this year but do not recognize. You get to defer. Rollover is a qualified small business stock gain. This is a great provision in Section 1045 that allows you to, if you have gain on the sale of qualified small business stock, but you don't meet the 5-year holding period for an exclusion, you can defer that gain if you roll it into another qualified small business within 60 days of the sale. So another way you can defer income here. Installment sales are always a great way to defer income. This is where you sell, let's say, stock, non-publicly traded stock. There's an exclusion for publicly traded stock. But if you sell non-publicly traded stock and receive payments beyond in the next tax year, then you have an installment sale and you can defer some of the gain based on your gross receipts percentage of the money you receive. So that's a great way to push off income into later years, particularly if you're not receiving the cash. You wouldn't want to recognize the income in advance of the receiving the cash. Two other things here, contributing to a 401k and a health savings account. It's just these obviously just a way to get, you can put pre-tax money in these accounts. HSAs are wonderful. They give a triple tax benefit because you get a deduction, the growth is tax-free, and it comes out tax-free. But you have to be in a high deductible health plan. The limit this year you can put in there in the HSA is $3,600 for an individual and $7,200 for a family. That goes up, I think, slightly next year, $50 or something for an individual. And don't forget catch-up payments. If you're 50 or older, you can add another $6,500 this year into your 401k or SEP. And if you're 55 or older, you can put an extra $1,000 into your health savings account. So we have many clients who use their health savings account like a like an additional Roth IRA. So they can accumulate money in their health savings account. Many accounts now have an investment feature. You roll it into an investment option in mutual funds, and this account builds value over time, and you're paying for your health expenses with additional outside money outside the health savings account. So it does function like a Roth IRA without income limits, but you have to have that high deductible plan. But it's something to think about. Next slide. This one here is how to accelerate expenses, right? So you push off your income to next year. If you accelerate expenses this year, you have less income this year. Again, this is assuming you're not in that those 10 and $25 million brackets. So you can prepay some of your rent and taxes. So you can't prepay 3 years of rent and deduct it this year, but you can prepay up to 12 months of rent. There's some case law saying you can deduct it this year. Same thing with taxes. If you pay some taxes this year, state taxes, for example, you can deduct them. Purchasing equipment, this is something that businesses really can take advantage of. So if you purchase equipment this year and let's say you put it into use, like a truck or something, and you buy it December 31st, you can expense the whole amount of the truck, or you can take 100% bonus depreciation this year, even though you place it in service toward the end of the year. So that's the nice thing about bonus depreciation and 179 expensing. If it applies, there's no requirement that it be in service the whole year. So we do recommend, if you want a deduction for your business, to, you might want to purchase some large equipment before year end rather than next year, if you want to take big deductions this year. We talked about paying your mortgage interest on your home mortgage is one way. You make the January payment in December. Pass-through entity tax, right? We talked about that state and local deduction limitation. It is $10,000 now, but the many states, I think over 12 states, have passed a pass-through entity tax, which is one of the workarounds around this 10,000 SALT cap. So that the entity, in most cases, are elective. I think some states are mandatory. But if in the elective ones, you elect to pay tax at, say, the partnership or S Corp level, and that way you avoid the limitation, and you just deduct it in the amount that's passed through to the owners of the partnership or S Corp. Paying estimated state tax payments early is another way. We talked about that. So the last slide before I turn it over to Jeremiah to continue with the federal state tax planning, are ideas to accelerate expenses. So bunching is very important. Over 90% of the people in this country take the standard deduction because it's so large these days, right? As a result of tax reform in 2017. This year we have a $12,550 deduction, or over $25,000 for married filing jointly. Very large. So in order to itemize, you need your expenses to exceed $25,000 if you're married filing jointly. So you need your charitable deductions. You can only put $10,000 of state taxes in there. So you're looking at interest on your mortgage and charitable deductions being the two other big ones. It could be medical expenses in excess of 7.5% of AGI, but charitable deductions and interest are the two big ones. So if you're going to make a deduction, a charitable contribution, date and mail the check this year, you can still get it at the end of the year. You can use a credit card payment. If you pay online, even though you don't make the credit card payment until next year, it's deductible this year because you're paying with borrowed funds. You can contribute to a donor advised fund this year. The nice thing about a donor advised fund is it enables you to donate today, but the money sits in the fund and you can allocate it in later years. So this enables you to bunch your expenses. Ideally, you want to bunch your charitable contributions, let's say into this year, let's say you were going to make a $2,000 contribution this year and next year to the same charity. Perhaps you make $4,000 this year and $0 next year. By bunching them up, the hope is your itemized deductions will exceed your standard deduction, and that'll give you a better tax outcome. So double up on those charitable contributions, pay every other year, every third year, accelerate medical expenses. If you're close to that threshold, obviously don't get surgery you don't need. We're not encouraging you to spend money on medical expenses you don't need. But if you have these expenses coming, and you would benefit by pushing them into the end of this year rather than waiting till January, let's say, to get a procedure you were thinking about getting. The last thing I'll mention, S Corps and C Corps, the incentive goes the opposite ways. With an S Corp, typically, the owner is incentivized to make a paid less salary because of the employment taxes apply. In a C Corp, the owner is incentivized to pay more taxes to get rid of that double taxation. So even though the incentives go both ways, just consider, with regard to if you want to accelerate expenses, you can also do that with your C Corp or S Corporation. So as we turn over to the next slide, introduce you to Jeremiah Ramos, who's the newest member of our national tax group. And he's going to take you through the next 10 or so slides before we get to next presentation.
Yep, so as Dan mentioned, the general rule is to defer income. Why pay tax this year when you could pay it next year? For this year, it is a unique situation for people who want to accelerate income. Let's say you have large gains, you sold your business, or you just want to push income into this year to take advantage of the lower rates. You expect rates to be higher next year. You could definitely do so. So things to consider is that 3 and 5% surcharges for individuals that are going to be in the $10 million to $25 million range in terms of AGI for next year. Also, there's a change that's going to be expected for individuals with AGI over 400,000, where you're going to have a net investment income tax is going to be attributable to active trader businesses. So as of now, if you have income from active trader business, let's say you own your own business, you're generating income from that business, generally that's not going to be subject to that 3.8% tax. But if the provisions go through and you have that additional 3.8% on top of the sale of your business or generating income from your business, that's going to be an additional top rate of as high as 48.8%. In an example, if you were to sell your business in 2022 for $100 million. So in this example, you're selling your business in 2021 for $100 million. You're going to be taxed at a top rate of 37% versus if you delay it till next year, you're going to have about a rate of 48.8%. So it does make a bit of a difference. We're talking about a 10% gap. So if you're looking at a $100 million gain, you can see that just that alone between accelerating to this year versus deferring to next year, you can save a considerable amount of money. Next slide. So ways to accelerate income for businesses, you can elect out of bonus depreciation or not take 179, you just take the normal depreciation, which is going to considerably increase your income. You can trigger some of those capital gains this year instead of waiting until next year. So if you have any large sales or distributions from C corporations, maybe speed that up before the end of the year, before doing that sooner rather than later, and pushing that income to next year. Also, if you have a change in accounting methods, if you're changing from, let's say, accrual to cash basis, or if your business is getting larger, now you're forced into accrual methods, maybe looking at different strategies to accelerate income or defer income based on if you're on cash basis or accrual basis. But overall, you don't want to let the tax tail wag the planning dog. What this means is essentially you don't want to be in a position where you're doing things in your business that aren't conducive for growth long term. So for example, if you're expecting a large gain and you're going to trigger that gain before the end of the year, if you don't have the cash flow to pay the taxes, it might not be the smartest idea to deplete your cash reserves for the next year. If you're expecting you need to make large purchases, you just need that cash in your business. So sometimes there's more of a business utility to pay the tax over time. You might pay more in tax, but the use of that cash probably is going to be more beneficial to you and your business over time. On the personal side, there's some ways to accelerate incomes, like triggering long-term capital gains in 2021 rather than 2022. You can do this without messing with your portfolio balance in a sense that you can use some of the wash sale rules that don't apply to gains. So if you were to sell one of your assets and then subsequently repurchase it and rebalance your portfolio after year end, you can do that. Those wash sale rules only affect losses. So you could definitely trigger some of those gains just to push it into 2021 versus 2022, but that will leave you without cash to pay those taxes. So you want to make sure if you were going to do that anyway, if you're saying, for example, you want to make a large sale of assets in the next couple months, maybe think about selling it before the end of the year, especially if you're going to hit that $10 million or $25 million thresholds where those excise taxes are going to come in the 5 and 3%. This year might be a good year for IRA conversions if you're expecting rates to go higher, converting those to a Roth, especially if those balances aren't tremendously high and you have a large window before you retire. You can get that benefit of the tax-free growth over time in that Roth IRA account, especially if some of the pending legislation is going to go after some of those Roth conversions or limit the amount that you can put into those Roth accounts. Definitely this year would be a good year to plan for that, or consider doing that sooner rather than later. Also, if you have any required minimum distributions, now's the time to take that, or if you wanted to take amounts in excess of that required distribution, just to accelerate those incomes into this year rather than next year, that's also an option. And then lastly, exercise those stock options or make a 83B election on deferred compensation. Next slide. So an interesting bit that we're going to talk about shortly is there is an interesting scenario under the CARES Act and some of the other COVID legislations where they expanded greatly some of the credits available to families, especially families who have multiple children. A lot of practitioners are coining this as the savers credit. It's not the genuine savers credit where if you're putting money into a 401k or a traditional IRA where you're going to get some kind of credit. This is the thought that if you're in an AGI around 150,000 to 200,000, that you can actively reduce your AGI by contributing to 401ks or contributing to a SEP account where you can lower your income under that $150,000 threshold to take advantage of some of these credits. So this might not apply to a lot of taxpayers, especially if you're in the higher income brackets. But if for some reason you have large losses this year, your income is expected to be lower than usual, you could get a family of 4 with 2 kids can get up to $20,000 in credits. So if you look at the advanced child tax credit of children under 6 years old, it's going to be $3,600. For children between 6 and 17, it's going to be $3,000. The child independent care credits are going to be $4,000 per child, or a max of $8,000 total. If you didn't receive the recovery rebate credits or those stimulus checks in the early part of 2021, you can receive those on your 2021 return in a form of a credit. So if you have 4 individuals in a household, you can get $1,400 per person. So as you see, if you are heading towards the end of the year, your AGI is much lower than usual, you're around that 150,000 threshold, you can take steps now in order to lower that AGI to take advantage of those credits. And like I mentioned, if you add up all those numbers, you can quickly see how you can get over $20,000 in credits just for a family of 4. Next slide.
And here's our first polling question. Do you typically speak to your tax advisor about year-end tax planning? Yes, no. We'll give it a few more seconds as the polls are still coming in. All right, we're going to go ahead and close the poll.
So it looks like the majority said yes. All right, with that, we're going to jump into our next slide. Year in planning for businesses. Next slide. So 2021 has been an interesting year for our clients. A lot of businesses have had their best year ever, while some of them have had their worst years. So it all depends on how the pandemic specifically impacted your business. But generally, if you're expecting to take losses or deduct those losses in 2021, there are some planning opportunities before the end of the year, specifically when it comes to basis, at-risk, and passive loss rules. So as we know, if you're going to take those losses in 2021, you want to make sure that you have sufficient basis. And this especially comes into play if you have an S corporation, just because you don't get the debt basis as you do for those partnership returns. So if you are an owner of an S corp, you are running into basis issues, especially if you took large losses in 2021. You want to consider contributing funds or loaning money directly to your S corporation, just to take some of those losses in 2021. You don't want to be in a situation where you're taking wages from your S corp. Let's say you have $200,000 in wages, and then you're passing through a $200,000 loss from your S corp, and you're thinking that you're not going to pay any tax for the year. But if you don't have enough basis to deduct those losses, you could be in a situation where you have an overall loss in your business, but you end up paying tax on $200,000 of income. Another thing to look out for is filing those PPP2 loan forgiveness applications. Remember, the loan forgiveness gives you basis in the form of tax-free income. The timing of that is quite important, because if you get that loan forgiveness before the end of the year, you can take that basis and you can take losses against those amounts. So if you have a large amount of payroll that you use for those PPP2 amounts, if you want to deduct that payroll and have enough basis for it, you want to make sure that you get a decision before the end of the year. I know we're a few weeks out before the end of the year, but the SBA's turnaround has been considerably better over the past couple weeks in terms of handing out those decisions. So if you haven't filed that PPP2, by the end of this week would probably be the best to get that decision before the end of the year. Next slide. Another thing to look out for is the return of the excess business loss limitations. This we saw 1 year, I believe in 2017, impacted some taxpayers in 2018. But under the CARES Act, there was a temporary suspension of those EBL limitations for 2018 through 2020. So a lot of taxpayers who were taking losses during those years were not impacted. However, these rules come back from the TCJA of 2021 thresholds, which are 262,000 for individuals, and for married filing jointly is 524,000. What that means is any amount of losses in excess of those amounts will not be allowed, and they'll be carried forward to future years. So we know that there are passive loss limitations, basis limitations, but this is a limitation on top of all those other limitations. So you could be actively participating in your trade or business, you could run your business, you could take salary from that business. However, these rules will limit the amount of losses that you're deducting. So if you have an overall loss of $1 million in your business and you're expecting to take the total amount of that because you're actively involved in that business, you're taking salary, you have investment income that you're thinking you're going to take those losses against, what these rules do is they'll limit the amount of losses you can take in any given year. So for this example, if you're married filing jointly, you could only deduct half of that loss, or 524,000. Generally, those losses will turn into NOL, so you can take them in future years. But current legislation will change these rules significantly to make it much harder to take those losses. So the current legislation that's being proposed would make these changes permanent. These will expire naturally in 2025. Under these proposals that make it permanent, they disallow any EBLs. So if you have a $200,000 loss, $500,000 loss overall in your business activities, none of that will be deductible in the current year. And on top of that, they want to change the NOL rules where every year you will have to do the test. If you have overall business losses, you can't take any of those losses. Next slide. Also, remember, QBI deductions are still available. There's been a lot of discussion in the news about different proposals of limiting deduction or eliminating it altogether. But as of the current draft of the legislation, it looks like the QBI elimination has been removed. So QBI deductions are still available for 2021 and still available through, I believe, 2025 when they expire. The proposed legislation does not include any additional QBI limitations. So you want to proceed as normal, any planning year and planning that you have when it comes to maximizing that QBI deductions. What is unclear, many people have been asking, and there hasn't been much IRS guidance around, is if the ERC expense disallowance will impact those wage limitations. So if you took ERC credits, let's say you had a credit of $1 million, your total payroll is $2 million. The question being, will you get that QBI limitation of that 50% of wages at the $2 million that's going to be reported on the W-3? Or is it going to be net of the expenses that were disallowed of $1 million? Now that's quite important because you can have taxpayers that are on the cusp of being limited by their wages. And if you tack on ERC disallowance, you can have a lot more of those deductions, your QBI deduction being limited. Next slide. There's also some NOL changes for 2021 and going forward. So remember the CARES Act changed NOL rules for 2018 through 2020. These NOL rules allow taxpayers to carry back losses for 5 years and also carry forward those NOLs indefinitely. Remember the TCJA modified those rules so that you can only take NOLs up to 80% of taxable income. Those rules will come back in 2021 and in subsequent years. So that's another limitation on top of all those other limitations. If you have losses, it's going to be more and more harder to take those losses going forward. Next slide. Some other CARES Act provisions before we get into some of the international tax planning are PPP loan forgiveness. Remember that's going to be tax-free and the expenses are deductible. And like I mentioned, you want to make sure you get that forgiveness before the end of the year so you can take that tax-free basis and take those losses against that basis. Also, if you've taken RRF or any SVOG grants, those will also be tax-free. There are some reporting requirements before the end of the year, so you want to make sure that you log into your portal and you upload any documentation that's required. Once again, that's tax-free and the expenses are going to be deductible. Lastly, the ERC or the Employee Retention Credit. These are payroll tax credits that a lot of clients got if they were impacted by government orders or if their gross receipts dropped more than 20% in 2021. These amounts are considered tax-free, but they will reduce your expenses. So if you're reducing the expenses, your income is going to be higher. So in theory, you're going to be taxed on that amount. So if you got $1 million ERC credit, be expected to pay taxes on that $1 million of income in 2021. Some of the states might not conform. It's going to be similar to R&D rules. So if you have some states that conform, that allow the deductions, you can save some state tax and making sure those are reported correctly on your returns. With that, we'll go to a next polling question, and then I'll switch it over for some of the international provisions.
And here's our second polling question. Do you think you will take specific actions this year end to manage your tax liability? Yes, no. We'll give it a few more seconds as the polls are still coming in. All right, we're going to go ahead and close this poll.
Great. So Kimberly's going to step in now and talk about international tax planning. Great. You're on mute, Kimberly. We still can't hear you.
I'm not on mute.
Now we can hear you. Great.
Can you hear me now?
Yes.
Okay, great. I'm going to quickly run through some of the former changes that came out of the Tax Cut and Jobs Act of 2017. The first is GILTI, the Global Intangible Low Tax Income. Basically, if you have income in excess of a 10% return on your fixed assets, you're going to pay tax on that immediately. You will get, if you're a C corporation, you get a 50% deduction. So the tax rate there would be 10.5%. And you can use 80% of the foreign taxes paid to offset that GILTI income. So how do you plan around this? A lot of this planning has to do if you're not a C corporation. First, if you're paying a tax rate of at least 18.9% in the foreign country, you'll be able to claim a high tax exemption and not have to calculate the GILTI. If you are an individual, you can make an election to be treated as a corporation under Section 962 and then be eligible for the 50% deduction and the foreign tax credit and hopefully eliminate or minimize the GILTI impact. Or you can restructure yourself into a C corporation. Now, GILTI comes into play exactly at year end. So you need to have any restructuring done before year end, so time to get going on getting any of that planning done. There are some proposed changes, which I'll get to in 2 slides. The other big change of TCAJ is the foreign derived intangible income. And what is that? Again, it's a return on foreign sales in excess of 10% of your fixed asset investment. Basically, it's encouraged it's trying to encourage you to onshore your intellectual property and earn foreign sales from using that intellectual property. This is available only to C corporations. It can cut the tax rate on your foreign derived income from 21% to about 13.125%. What you need to think about here are what is foreign use. And this was a big change that came out at the end of last year. You really need to look at what your foreign retail sales are. If you can look and see, is it being delivered outside of the US? Are your services being used outside of the US? Even if you're delivering it inside the US, are they going to send it on outside the US? So you can really make some changes by knowing where your sales are going or where your product or services are being used. Next slide. So what can you do now? If you have goods and you have 3 years open, 17, 18, 19, and 20, you can look back and say, wait a second, I did not claim the foreign derived intangible income. I can go back and review purchase orders, talk to my clients, know where my services are being used, know where my products are going, and actually pull them into the foreign derived intangible income. You can also review how you've allocated your costs against your foreign derived intangible income to increase that and reduce your taxes. Now, as a word of caution, the World Trade Organization will likely challenge the FDII, claiming it's an unfair subsidy, so it might not be around forever. Next slide. There will also be changes that have been proposed in the Build Back Better Act. Under the Section 250, which is that 50% deduction for GILTI, they're going to reduce that 50% deduction to a 31.75% deduction, and they're going to take a reduction of 21.875 for FDII. So the FDII tax might go up a little bit, the GILTI tax will go up a little bit. They're also looking to reduce your qualified business asset investment or your adjusted basis of your fixed assets and limit that to 5% instead of 10%. So that means your FDII will go up. You'll be able to get more income taxed at a lower rate, but your GILTI inclusion will also go up. Another big change is to have you calculate GILTI on a country-by-country basis. Previously, you looked at all of your foreign income and you lumped it all together. And that was done at the shareholder level, and you could net gains in one country with losses in another country. Now they're going to have you calculate GILTI on a country-by-country basis. Since they're doing that, they will allow you to carry your net tested losses forward. Previously, if you had a loss in one country, it could offset a gain in the other country, but you couldn't carry that loss forward to the next year. Now, on a country-by-country basis, you'd be able to carry the loss forward. Additionally, instead of using only 80% of your foreign taxes paid as credits, you can use 95% of your foreign taxes paid. So a lot of big changes coming to GILTI and FDII in the Build Back Better Act. Next slide. Big changes to foreign tax credits potentially coming. Again, a country by country basis application of your foreign tax credits. Right now, you sort your income into various baskets: passive, general limitation, resource by treaty, high tax kickout. You'll have to do that, but then impose that on a country by country basis as well. So you won't be able to offset income in a low tax jurisdiction with income in a high tax jurisdiction, basket the income together, basket the taxes together, and get everything to even out. Now it's going to be done country by country. Right now, you're allowed a 1-year carryback of your foreign tax credits. They're looking to disallow that. Right now, you can carry forward your foreign tax credits 10 years. They're looking to reduce that to 5 years. Again, this is all under the Build Back Better Act. Also, right now, guilty foreign tax credits are use it or lose it. If you don't use it in that year, you will lose the benefit of that on a go-forward basis. Now, with all the changes to guilty, they actually will allow you to carry forward your guilty foreign tax credits. Guilty will be a complete separate basket as it is now. Next slide. Taxation of the digital economy. You've probably been hearing a little bit about the OECD, the Organization for Economic Cooperation and Development, and changes they've been making through a big initiative called BEPS, Base Erosion Profit Shifting. And part of that is focusing on taxation of the digital economy, looking at cross-border sales where there's not goods moving, where there are not necessarily services that are provided by a person. But think about like Netflix. Think about LinkedIn, where Netflix could be selling into a foreign country without ever setting foot in that foreign country, without ever, they can just contract with users in France and get some income in and never set foot there. And right now, that's not being taxed there. France did impose a digital services tax, but that, through these changes, will be eliminated. So that the OECD has looked around and said, who has the right to tax these digital sales, and how should we allocate the profit around the world when you have sales from one country to another country and it's all being delivered digitally? So internationally, we need to come up with some consensus, and this is basically called Pillar 1 of the BEPS project. So we're looking for a way. They were looking for a way to mechanize, this controversy and make sure that we avoid double taxation. So right now they've come up with a market or a consumer-based presence taxation. So this will apply to companies with greater than $20 billion, billion euros in revenue, where they have a profit margin of greater than 25%. If they have that, then 25% of the profit will be reallocated to jurisdictions where they have sales other than their home country. So the home country will get 75% of the profit, and other jurisdictions will get 25% of the profit based upon where they have sales. So that's coming. They're looking to implement this. I believe the implementation date they're looking at is January 2023. Again, it's coming out of the OECD, so it might take some time. Next slide. And this has been in the news, the global minimum tax of 15%. So all 136 of the OECD members have agreed to this. There are 4 countries, Kenya, Nigeria, Pakistan, and Sri Lanka, who have not yet agreed to the 15% global minimum tax. Interestingly, Ireland was one of the holdouts. Ireland has a 12.5% corporate tax rate, and they are agreeing to the 15% global minimum tax rate. This is Pillar 2 of the OECD big program on BEPS. This 15% minimum tax will apply to global companies who have more than 750 million euro in annual global sales. And what happens is, in the home country, they will look at all of the countries where they have income, and if they're not paying at least a 15% tax in that country, you can top up to that 15%, and that goes to the home country. So the idea here is to really stop pushing profits to the lowest jurisdiction. So stop trying to, have a race to the bottom on corporate income taxes worldwide, but to basically set a level playing field. So you do business, you pay your 15%, and all the countries are happy. Next slide. Why do you need to think about year-end planning? What do you need to ask yourself? And if you ask yourself these questions, call an advisor. Do you sell goods or products around the world? Can we claim the FDII? Have tariffs impacted you? You might want to rethink your transfer pricing if you're paying a lot of tariffs. Again, do you have your study in place? Do you have documentation for your related party transactions? If you pay income taxes or earn income in a foreign jurisdiction, let's make sure we're capturing that and not paying double taxation anywhere. Here's a big one. Have you had to be relocated, or have you been impacted by the 2020 and 2021 COVID restrictions? And how should that impact your planning, your transfer pricing, and your worldwide allocation of profits? If you're an individual, are you eligible for the foreign earned income exclusion? And if you're a beneficiary of a non-US trust, you must talk to us, because tax planning around that is key. If you don't do the appropriate planning, you could end up paying an accumulated profits tax, which is, Hal will tell you, is not pretty. Next slide. We can help you. You know, businesses operate globally, no matter how big they are, and we can help you determine the best way to structure and the best way to get the most profit into your pocket. Technology is making our world smaller, so more and more countries are requiring a lot of worldwide reporting. One thing I want to make sure you know, if you are a partnership or an S corporation and you do business internationally, or you have international investments, starting with the 2021 tax returns, there's a new schedule, K2 and K3. K2 is like the Schedule K, but it's for international. What used to be literally a few lines on Schedule K has become an 8-page form on reporting your international activity by basket, and pretty soon it'll be by country. So a lot of additional reporting around foreign business by pass-through entities will be required in 2022. We will be doing seminars specifically on that. So if you're a pass-through, make sure you talk to us. And with that, I believe we go to a polling question. Which of the following acronyms is incorrect? TCJA being the Tax Cut and Jobs Act of 2017, GILTI being the Global Intangible Low Taxed Income, FDII being Foreign Derived Intangible Income, or as the BBBA will change it, is Foreign Derived Innovation Income, or OECD, the Organization for Economic Cooperation and Disclosure. You'll find that as you do international tax, there are more and more and more acronyms.
We'll give it a few more seconds as the polls are still coming in.
If you have any questions, please don't forget to enter them in the chat, and we will take care of this at the end. And as soon as we close out the vote, I will look forward to turning this over to Hal Tur, who will talk about estates and trusts.
All right, gonna go ahead and close this poll.
Great, the correct answer, the incorrect acronym is Organization for Economic Cooperation and Disclosure. It's Cooperation and Development. So with that, Hal.
Good afternoon. So, you know, we talk about proposed tax law changes.
You're on mute.
I'm unmuted.
No, we can hear you
I
now.
can hear you now.
Okay. So, when we're talking about proposed tax law changes, it's like going to
I still can't hear you.
Dan, can you hear me?
Yes, we can hear you.
Can't hear you.
Okay. It's like going to the baseball game where you see the ball with the baseball caps and trying to find the baseball under which cap. Everything keeps on changing and we don't know where the bouncing ball will land. So just a brief overview, the Tax Cuts and Jobs Act in 2017 doubled the basic exclusion amount. That's the estate and gift exemption from $10 million in 2011 dollars. So in 2021, the current estate, gift, and GST exemption is 11.7 million per individual. So for a married couple, it's 23.4 million. So less than 1% of those passing away are subject to an estate tax. But that's the American dream, where everybody thinks that eventually they may be subject to an estate tax, but less than 1% of individuals are. If there is no changes in the law in 2026, the state and gift exemption and GST exemption goes back to pre-Tax Cuts and Jobs Act law, which is 5 million indexed with inflation. As Dan said, based on inflation, it's about $6 million. The proposed legislation by House Ways and Means was to accelerate that sunset to January 1st, 2022. As I said, to be projected to be at 6 million. When President Biden issued his framework at the end of October for Build Back Better, these proposals were eliminated. However, as I said, the law doesn't change. The exemption is going to go down eventually in 2026. So for those who have an estate greater than 23.4 million, doesn't mean you have to wait now. You don't have to rush now, but you should try to do some estate planning before the exemption does get decreased. And the state attorneys out there will be very happy if it's done now as opposed to waiting before the December when the proposed changes would occur. Next slide. What was not in the proposed legislation was any change in the tax rate above the exemption. So the tax rate stays at 40%. The annual exclusion, 15,000. That's what the freebie you get every year per donor. It is per donor, not per donee. Per donee, not per donor. I'm sorry, that is a type. 30,000 per couple. So if you have 5 children, 15,000 times 5, you can give them 75,000, married 150,000. That's the freebie every year. And over time, that could accumulate to significant gift tax savings. Also, what they got rid of was elimination of step up in basis at death. They wanted to make it a carryover basis at death or a capital gain event. That was eliminated, but that's very important. So if an individual has high value, low basis assets, those are the assets you want to retain. So when you pass away, they get a step up in basis. And when you want to gift assets, you want to gift assets with a high basis, not as much appreciation, to avoid gifting a tax liability to your children or grandchildren. Also, what's still around is portability. So portability is where I say Congress likes accountants and not attorneys. They didn't want to have complexity for estate plans. Prior to 2012, if you passed away and you didn't use your exemption at the time, it was lost. Now, if you give everything to your surviving spouse and your spouse is a U.S. citizen, as long as you file an estate tax return, not only can your assets pass tax deferred, whatever exemption you didn't use during your lifetime goes to your surviving spouse. Also, there were proposals to eliminate the ability to do what are commonly referred to as crummy powers, annual withdrawal rights from non-grantor trusts, to consider gifts to those trusts for annual exclusions. One thing to point out, where on the income tax side for estates and trusts, the fiduciary income tax returns, where Dan and Jeremiah talked about the 5% and 3% surtax hitting at 10 million and 25 million for individuals. As we all know, trusts and estates have condensed tax brackets, but here it's really condensed. 5% hit starts at 200,000 of it modified adjusted gross income, and the additional 3% hits at 500,000. So no 10 and 25 million dollar levels for trust and estates. Those surtax will hit at much lower levels of income. Next slide. So what we're talking to clients, again, if you have a taxable estate, it makes sense to at least utilize one spouse's estate and gives tax exemptions now, what I talk about, to get at least one bite of the apple. But to use it you have to make a gift in excess of the exemption. That could go down. In my example, the $6 million, because the IRS issued regulations to state that there's no clawback of an exemption. So if this year, my example, I make a gift of 11.7 in 2021 and then pass away when the exemption is 6 million, the IRS is not going to come back for tax on that 5.7 million. However, how the tax calculation works, that same individual makes a gift of $6 million and passes away when the exemption is 6 million. Well, the exemption 6 million, less what I used of 6 million, I have no exemption. So where, a lot of times we'll tell clients to gift split and split the use of the exemption between spouses. For moderately net worth clients, moderately being anywhere from 20 to 40 million, and they're looking to utilize an $11.7 million exemption, use one of them. Use one spouse's exemption, make the large gift, utilize that exemption for the one spouse, leaving the other spouse remaining with the other $6 million exemption for future gifting or future estate tax. Next slide. So talk about making large gifts. Again, if the exemption goes down, either at 6 million in 2022 or at minimum 2026. We are talking to clients to establish what do I call a spousal lifetime access trust. One spouse utilizes their exemption, $11 million, gifts it to a trust. The other spouse can get income principal as needed while they're alive. Upon their death, it would go to children and grandchildren. Two things that I always tell clients and get a little chuckle. One, you want to be nice to that other spouse, because if you get divorced, then you lose access to those funds. In addition, you want to make sure that spouse has their vitamins and eat their spinach, because if they predecease you, you lose access to those funds, because once that beneficial spouse passes away, then the assets are for the benefit of children and grandchildren. There are some attorneys that will say spouse A can create a spousal lifetime access trust for B, and B can create one for A, and you could create the trust having different provisions, so that it does avoid the reciprocal trust doctrine. I'd be careful to doing those two in one tax year, close to year end, having the same trustees. You really want to make sure that you don't fall victim to the reciprocal trust doctrine, because if the IRS rules that they are reciprocal trusts, it's as if you did not make a gift, and they would disallow the gift as if you did not utilize your exemption, and those trusts would be included in this state. Next slide. Significant proposals in the legislation, which are not in the current framework, but to give an idea of what possible legislation would look like in the future, is the proposed legislations against grantor trust. So what a grantor trust is, it's an irrevocable trust that's outside of one's estate for estate tax purposes, but there's provisions in the trust that would allow the income earned by that trust to be included in the grantor's income tax return. And what that does, by paying the income tax, is a tax-free gift to those trusts. So greater wealth can be built up in the trust, and by the grantor paying the tax, reduces their taxable estate. So a couple of provisions, again, not in the current proposal, but things to look out for, is where there would be, in the future, if you had created those trusts and the legislation changed, distributions would be considered a gift, or you converted grantor trust to non-grantor trust, it'd be considered a gift at time of conversion, eliminating the ability to do transactions between the individual and the grantor. So there's a technique which we'll talk about a little bit, which we like to do with sales to defective trust, which is an estate tax-free technique, or the ability to swap assets. clients create a grantor trust. One of the provisions you can use is to allow the grantor to swap assets of equivalent in value with the trust. And I talked about if an asset is in someone's estate at their death, they get a step up in basis. If it's outside of the estate, it doesn't. So for certain clients that are elderly, when there are appreciated assets in these grantor trusts, we don't wait till the last minute, but we look and we swap out cash and bonds for highly appreciated equities. The cash and bonds would go into the grantor trust. The highly appreciated equities would be in the grantor's estate, and then we get a step up. These proposals would eliminate that. And then also they want to, if you have an irrevocable life insurance trust, any gifts to those trusts would include part of those new contributions as includable in the grantor's estate. This is highly unlikely given the significant life insurance industry and lobby that we have in the United States, but just to be careful that the proposal where you do have life insurance trusts, you may want to pre-fund those trusts with premium payments before any changes in the law. Next slide. Another thing that the IRS and Congress don't like is discounts for transfers of family limited partnerships to take discounts for lack of marketability and control. Could still take the discounts for an active business. So if you have an active business and you convert into voting and non-voting stock and you gift the non-voting stock to your children or trust for their benefit, you can still get the discounts for lack of marketability and control. But there is proposed legislation. It's not in the current bill, but was proposed legislation. If you had family limited partnerships with marketable securities or passive real estate, you would not be able to discount the value and not be able to leverage the use of your exemption for lack of marketability and controlled discounts. Next slide. So one thing that Dan and Jeremiah talked about was the QSBS provisions, qualified small business stock provisions. And one thing with that $10 million exclusion is the planning technique of what's called stacking. You can stack or multiply the use of that exemption. And one way to do that is through an incomplete non-grantor trust. So they're commonly referred to as either Ding Trust because it's a Delaware incomplete non-grantor trust, Ning, Nevada, or Sing, South Dakota, where you can create a trust. It's not a completed gift because the grantor is a beneficiary of the trust. It would be included in their estate. But since it's a non-grantor trust, it is a separate taxpayer. And if you contribute qualified business stock, QSBS stock, you can get an additional $10 million exemption. And depending on your state of residency, could also avoid the state tax on that sale. So we do see these incomplete non-grantor trusts as a planning technique to multiply or stack the ability of using that QSBS exemption. Next slide. So again, now is the time to plan. We know that the exemption, if there's no change to the law, the exemption will go down in the future. Things that we do, intrafamily loans, even though interest rates have gone up a little bit, they're at low, historical low rates. So these are the rates at December. So you can loan money to family members. Long-term rate is for more than 9 years at 2%. You loan the money to your children at 2%. They earn 8%. They pay you the 2%. That 6% is outside of your state and they can earn that money gift tax free. Two techniques that we talked about with clients are the sales to defective trust and a charitable lead trust. I'll go through those two in the next slides. Next slide. So a sale to a defective trust, it actually, here's the write-up, but I'm going to go to the next slide so we can go. I think it's easy to talk about it graphically. Here, an individual sets up a trust, an intentionally defective trust, meaning it's outside of their estate for estate tax purposes, but for income tax purposes, it's a grantor trust. I either take non-voting stock or limited partnership interest, and I sell those assets to the trust and they take back an installment note. So what that does, it freezes the value in my estate. Any future appreciation is removed from my estate. Since it's a grantor trust, it's as if I'm selling to myself. To do this, you have to make a seed gift, because the IRS says if I sell something to, say I sell an asset to Dan and Dan has no money, he doesn't have any collateral, it's not a sale, it's a gift. So usually you fund this irrevocable defective trust with 10% of what you're going to sell to have seed money for collateral. You sell the assets, you take back the note. Hopefully the assets are high cash flow producing. The note's at a low interest rate. As I said, right now, the AFR is at 2%. The growth is outside of the estate, and you could use the cash flow to pay off the note prior to the grantor's passing. The grantor doesn't pick up the gain, doesn't pick up the interest on the note. However, they do pick up whatever income is earned by that underlying asset, the closely held business stock or family limited partnership. So it's a great estate freeze technique, and you can allocate GST exemption for that 10% gift. So not only will that trust be outside of individual's estate, but also for generation skipping. Next slide. The last item I'm going to talk about is where I have clients who have large ordinary income, either through exercise of stock options or deferred comp. There's a way where we could do a charitable lead trust. And again, let's go to the next slide, which a donor can put cash in a charitable lead trust, do a term of year payment to a public charity or a donor advised fund. The present value of that income stream creates an upfront income tax deduction to the donor. As long as you beat the payout rate, the donor's children will get the principal plus any appreciation. The IRS doesn't give you anything for free. You get the upfront tax deduction, again, to offset high ordinary income, but the income earned by the trust over the term is taxable to the donor. But if it's invested for qualified dividends or capital gain rates, it's at a lower tax rate. So you get the upfront tax deduction, time value money, and paying tax over time. And with that, I think we go to our next polling question.
And here's our fourth polling question. Which estate and gift tax proposal do you think will become law? Estate and gift exemption reduction to $6 million into 2022, elimination of valuation discounts for non-business assets, inclusion of grantor trust in grantor's estate, none of the above, all of the above.
And again, it all depends on that bouncing ball, where it's going to land under what cap, or none of them.
We'll give it a few more seconds as the polls are still coming in. All right, gonna go ahead and close this poll.
It's a mixed bag, which, based on what's happening in Washington, makes a lot of sense. And with that, we'll go to our last presenter, Jim Bartek, for the state and local update.
Sure, thanks, Al. So let's talk about a couple of key state tax issues you should be considering during year-end planning. I'm going to go through this very quickly so we can get some of your questions. A lot of you are familiar with the Wayfair case. Basically, South Dakota enacted a law requiring collection of sales tax if a company had $100,000 sales or 200 transactions in the state, basically nullifying the physical presence requirement. So economic nexus. So after that case was ruled on by the Supreme Court, ruled in favor of South Dakota, most states quickly enacted an economic nexus law with thresholds. This year, Missouri, Florida, and Kansas have all enacted laws. So this causes quite a bit of confusion because many services that may not be taxable in your home state may be taxable in other states where you have nexus for economic nexus purposes. For example, in Florida and California, software service not taxable, however, it's taxable in New York and Texas and other states. Now, Wayfair has no boundaries. Almost every industry has an issue. So next slide. So we're going to touch on briefly, even if you're not, if you have completed an economic nexus review in the past, it's always good to complete this periodically to make sure you're updating for new revenues and new products and services. We say at least annually, but probably during the year as well. You have to look at, do you have liability? You may need VDAs. How are you going to tell your customers you're going to charge tax? Do you have the right technology? It may take time to set up the system and so forth. And also opportunities are your vendors charging you too much in tax? Next slide, please. Now, state tax implications of mobile workforce, that's an issue that keeps coming up. Again, we just talked about Wayfair an economic nexus, but having employees in certain states might give you nexus in other states where you may not have had it in the past. Basically, you may have some kind of connection within that particular state, which could require you to collect or remit sales tax, file income tax, gross receipts, or other taxes. Next slide, please. Now, one thing here also, it's going to affect your apportionment in some states. It could affect the sourcing and payroll factor apportionment formula. Next slide, please. Now, generally, if an employee lives in one state and works in another, withholdings are generally subject to the work state. An employee then takes credit tax paid to the work state against the home state liability. Now, what's important here is that you need to know where your employees are. This could cause, obviously, withholding issues where you're withholding too much tax to one state. If you don't know where they are, that's definitely going to happen. And it could cause an overpayment to the other jurisdiction, or an underpayment in the jurisdiction where they moved. So it's important to understand where they are. States are not willing to give the money back too often. It could be penalties in the new jurisdiction as well. But most importantly for the company, this could have created nexus in other states and may not even know it. Next slide. I just want to address this real quick, expansion of the income tax nexus. The MTC, Multi-State Tax Commission, adopted a revised statement of information in August. Next slide. Now, Public Law 86272 was enacted in '59, generally prohibits states from imposing net income taxes where business activities in that state are limited to the limited to solicitation of orders of tangible personal property. It doesn't apply to gross receipts tax, sales tax, franchise tax, and so forth. So if a taxpayer sells anything other than TPP, the protection could be invalid. For example, installation, maintenance, or training. Next slide. Now, the MTC basically said that they cited the Supreme Court ruling in Wayfair, said that the seller via the internet could present a state in a meaningful way without physical presence in the traditional sense of the word. So therefore, if a business interacts with customers via the web or app, they are engaging in business activity outside the solicitation limitation in 86272. Okay, next slide. Now, basically, we say is monitor how these states address the statement, and again, taxpayers can challenge the state's positions and so forth. So, with that, we have a question, which And
here is our fifth polling question: what state and local tax issue are you most worried about in 2022? Sales tax, income tax, remote workers, audits, all of the above. We'll give it a few more seconds as the polls are still coming in. All right, gonna go ahead and close the poll.
Okay, there's no right answer to this one, so obviously most people are worried about all of the above. So if we can go on to the next slide. Okay, I'm going to go through this real quick. Again, Dan had talked about the pass-through entity taxes in the past. Again, there was an IRS notice 2020-75 issued during Trump administration, basically indicated the IRS will not challenge these PTE taxes. Next slide. And as you can see, this was the summer of 2020. Before that notice was issued, there were about 6 to 7 or so enacted. Next slide. And then in October, there's over 20 that have enacted these PTE taxes now. So next 2 slides of PTE action items. There's obviously risks here that need to be considered. Of course, there's the notice could be revisited by the Biden administration. There could be a resident state may not allow resident credits for the taxes paid on the entity level. And the next slide. And there's other risks out there, of course. For that reason, there's many reasons why you need to make sure that you actually take a look at the modeling and determine if it makes sense to do a PT election in a particular state. But number one, as Dan mentioned earlier, you want to make sure you make the payment this year, because if you don't make the payment by year end, you don't get the SALT deduction this year. And of course, continue to monitor state legislation. We update our webpage frequently. If you don't get a copy of the SALT shaker, please email us and we'll add you to the list. And of course, consider potential restructuring. Of course, this takes some time, so please make sure you begin your modeling as soon as possible. And with that, let's go to questions.
Okay, thank you, Jim. Thank you for that. So Jim, the question for you, you mentioned the IRS notice on the pass-through entity tax. Any status on the Biden administration, whether they're going to change it? I know you mentioned it briefly, but.
Well, we don't expect them to change it. I mean, basically that notice was issued 6 days after the election, so they rushed it out the door. So it's unclear if they would, basically squash the whole PT. Now, it becomes less likely every day, as you saw, new states are enacting PTE taxes. So again, politically, it's less likely, but we still need to monitor it.
Great. And then one more question while I can still got you here in the last minute that came through. It talks that in 20, I don't know, very specific question here. In 2021, for New Jersey residents who normally work in New York City but are required to work from home for most of the year, what is the correct treatment for filing a New York State non-resident return?
Yeah, that is a specific question, a longer answer. So if we have that person, maybe we'll reach out to them separately, Dan. We do. So that's Jeffrey. So we'll reach out to him. Yeah, we're out of time here though. Thank you everybody for joining. We do appreciate your attendance. Hopefully you got all the questions in. You'll get your CPE. And please reach out to us if you have any questions on the specific content we talked about.